Hi, I'm Mark Pengelly, the editor of Energy Risk, and I'm sitting here on the sidelines of Energy Risk Summit USA with Vincent Kaminski, who's a teaching professor at Rice University's Jesse H. Jones School of Business and also a regular contributor to Energy Risk. Vince, thanks very much for joining us.
My pleasure.
In general, the impact of new rules such as DoddFrank and MiFID II seems to be having a profound impact on the energy trading sector at the moment, one that companies, often companies such as this one, are complaining about. Now that you're no longer in the industry, what's your impartial view on all this?
Well, I have very mixed feelings about Dodd-Frank. On one hand, I believe that the reform of the financial system was necessary. Many parts of the financial system were rotten to the core. There were cases of abuse of customers, market manipulation, including some of the most important financial markets like LIBOR or the foreign exchange markets. On the other hand, I believe that the energy industry is an example of collateral damage. We didn't cause the financial crisis, but we are paying the price for fixing the system. Many solutions implemented under Dodd-Frank and MiFID are targeting certain problems which developed over time in the financial markets, not in the energy markets. I think that energy derivatives and physical energy markets are still a very small part of the overall market. And the rules written for the financial market participants in many cases don't apply to the energy players. But still we have to make a very significant investment to comply with the new regulations.
Of course. And as you say, the energy market didn't necessarily cause the financial crisis, but the fixes to the crisis are to some extent having an impact.
And the fixes are very expensive. For the last few years, the attention of quants, the attention of risk managers, the attention of compliance officers was exclusively on implementation of Dodd-Frank and MiFID. And the main challenge is that it's a moving target, because in many cases the final rules haven't been written. In some cases they are being contested in courts, and it creates a lot of uncertainty and additional costs.
Are we going to see a major change to the structure and the variety of participants in the energy market as a result of regulation, do you think?
I think that this is going to happen, but I have a long history in the energy markets, and in my memory, I can recall some firms that jumped into energy trading 5 times, left, came back, and the turnover of the participants in this industry happens irrespectively of the regulations. But having said this, I think that the recent regulations will lead to some important changes, primarily to banks and other financial institutions leaving physical business. And this is not necessarily bad. Physical trading is very expensive. The market is still very fragmented, illiquid. It's information intensive, labor intensive. And I think that many financial institutions, after experimenting with the physical markets, would go away, would leave the markets anyway, with regulations or without.
Right, and I think we're probably beginning to see that already, by the looks of it. Aside from regulation, probably the big topic in energy markets this year so far has been the dramatic slide in crude oil prices. They've actually come back since January, when Brent North Sea crude was touching beneath $50 a barrel in the front month. What's your take on that price movement that we've seen?
Well, having spent many years of my life in the commodity markets, it's not surprising. The commodity markets are very volatile, and in many cases, the producers create their own nightmares. And one of the very important factors contributing to the drop in oil prices was a very low level of interest rates. Low interest rates allow the producers to obtain funding on very good terms, and given the appetite for risk, which is typical of people who go into the oil business or natural gas business, if you give them money on good terms, they will use it to drill a hole in the ground, and they will produce. So I think that to some extent the drop in oil prices and natural gas prices is one of the unexpected consequences of low interest rates.
You're working on a book at the moment, the latest edition of Managing Energy Price Risk. It's volume 4, I believe. It's being published by Risk Books. It's edited by yourself. What areas? Well, let me start with this. What are you trying to achieve with this edition?
Let me elaborate a bit on my role in this publication. This is the 4th edition of the book, which was very successful in the past and became a standard reference for anybody who is in energy trading and risk management. I am a technical editor, and this is a function different from being an editor. You wouldn't like a person with my English language skills to be an editor. So I am a technical editor, and this means that
I think you're being too modest, by the way. But
it's so sometimes the quality of my writing reflects the efforts of the editor and the person who fixes the problems. Well, but having said this, my role is to select the potential topics, identify the contributors, and then once we have an outline of the book and we have potential contributors, I work with them to make sure that we avoid gaps and repetitions, that we use the same consistent terms across the book, that the text corresponds to the expectations of readers with different levels of technical expertise, so the language is accessible to everybody. And finally, sometimes I have to act as a school teacher, trying to make sure that everybody makes contributions, submits the chapters by the deadline, and comes back with corrections, modifications on time. And and this is probably the most important part of the entire process.
Now it's the 4th edition. What areas are you significantly expanding or updating in this version?
Well, I think that there will be many changes and many updates to the chapters included in the previous editions. There will be a new section, and this section is called The Winds of Change. And this section summarizes the most important developments that took place over the last 10 years since the 3rd edition. And I have to say that if somebody made a prediction in 2005, a prediction completely correct of what effectively transpired in the last decade, this person would be committed in 2005 and would spend a few years in a well-padded room, because nobody would believe that the things that have actually happened were possible. The shale revolution, to give you an example. We were expecting massive flows of natural gas to the United States to satisfy the domestic market.
In the form of LNG.
In the form of LNG. Today we worry about building liquefaction facilities as fast as we can to take natural gas to Western Europe and the Far East. The financial crisis, in 2005, practically every person who counted in the financial world believed in great moderation. We mastered, according to the views held in 2005, the business cycles and the financial world. We learned how to spread risk in society and to avoid potential financial crisis. And we had a moment of awakening in 2008, 2009, when the financial system, the world financial system, came close to crashing down. And we survived, but hopefully we learned the lesson, and some of those lessons will be reflected in the first section of the book, the Winds of Change, and also in the updated chapters in other sections of the book. We are also improving the chapters on risk management. We are adding chapters on management of price risk and credit risk, and also we'll be covering some markets which were omitted or didn't receive sufficient coverage in the previous edition. So we will be writing about natural gas outside the US, about electricity markets in Europe, about coal market, and I think that these are very important contributions.
Interesting. So there's a lot of additions there by the sounds of it.
There is a lot of new material.
You mentioned European power and gas markets. Europe is one of those places where there's been a move towards liberalisation, came a bit later than that in the US. Do you think that there's, are you encouraged by the progress being made around the world towards energy market liberalisation, or do you think that that's maybe stalled somewhat?
Well, I think it's to some extent it's stalled. I think that that the main thrust of the efforts in Europe is to create a unified European market with the same rules, the same conventions across the rest of Europe. And I'm a bit skeptical, that eventually it probably will happen. It probably should happen, but rushing it could be a mistake. And let me give you two examples. About 90 years ago, the first power pool, PJM, was formed in the US. And this was formed by a group of the electric utilities operating in the northeastern states of the United States, and nobody told them to create a power pool. They acted in their own best interest. They came to the conclusion that it makes sense to pool the assets, create common rules, common procedures, common business processes for moving electricity from the surplus areas to the deficit areas, to cooperate in the case of natural disasters, and this was a great success story. The PJM market is working extremely well. So, so people will act in their own best interests without being pushed in this direction by the politicians. Another example is FERC's effort in around 2002-2003, if I remember correctly, to introduce a standardized market design for the electricity markets in the United States. And this initiative was met with a lot of resistance coming from different parts of the United States. So many different producers and end users of electricity pointed out that conditions prevailing in different parts of the United States are different, and having a uniform market mechanism which applies to everybody without any exceptions, may be premature. And when I think about Europe, there are very significant differences between different parts of Europe. And I am sure that Malta and Cyprus are not really interested in having a unified electricity markets with the rest of Europe. I don't think that there are too many underwater transmission lines to Malta or to Cyprus from the rest of Europe. What I think makes sense is to start with certain solutions which apply to parts of Europe which have the same characteristics. Let's say Nord Pool is a good example. This was again a solution which emerged as a result of a voluntary effort. And then, once we have working regional markets, the final push to create a unified electricity market in Europe would be justified.
Right. Would you put the current coupling efforts, the market coupling efforts that are going on in Europe into that category?
That's what I had in mind, right?
So a coupling of like markets, essentially.
That's right.
Just moving on, I mean, before you entered teaching, I mean, before you sort of took sort of semi-retirement, you had a distinguished career in the energy industry. You worked for industry titans, you like Enron, Citigroup, Citadel, to name just a few. What would you say was the best moment, the highlight of your career?
Mm-hmm. Well, I have to say the following. It may be a paradox, but the best moment of my career was also the lowest moment of my career. When this was the time when Enron was coming down, and I was managing a large group of professionals, and I have to say that practically everybody in my group survived the fall of Enron with their reputation intact, and they found jobs in the industry without any problem. So I think that I created an environment for people who were my associates, allowing them to develop their skills, grow, and flourish. And this is not true. This is not true of every organization in the financial industry. When I was working on Wall Street, I had a boss who told me in a moment of frankness, I'll keep you working so hard that you will never grow to a level which would make you eligible to replace me. And wow. when I started managing people at Enron, my objective was to manage my group in a different way, and to create conditions for individual growth for everybody in my group. And I think, to a large extent, I succeeded. But this was also a very sad moment in my life. Some employees of Enron who had only one employer in their lifetime lost their life savings, and they lost their life savings because of many mistakes made by the management at the time. For example, the savings accounts held by the company on behalf of the employees were frozen because the service provider was being replaced, and people couldn't access their funds as Enron was going down. And this was a terrible experience because I talked to people who had only one employer in their lifetime. They had all the money invested in the company stock. There was one lady I knew who was just buying her first house, which was just about to buy her first house. She was close to being to 60 years old, and she couldn't, and she couldn't buy the house. She lost all her savings. So this was a terrible. This was a terrible moment in my life. But this happens.
Wow. Yeah. You have to take the rough with the smooth, but still, what terrible personal tragedies, and very real ones too. One of the things that we hear these days, particularly from people who focus on the quantitative side, is that there's perhaps less investment and less development of quant techniques going on in the energy market currently. Do you feel that's the case?
Yes, I think this is true. You know, and I think that there are many reasons why this happens. And you know, one reason is that development of new quantitative techniques doesn't happen in the vacuum, and it happens through collaboration of the academia and industry. And the problem is that in the case of a very cyclical industry, it's very difficult to keep attention of the academics. After Enron went down, many friends of mine in the academia you know, decided to abandon, against my best advice, the energy markets or the commodity markets and to move on to different fields. And they said, well, we cannot get any support now from the energy industry, we cannot get the data, you know, the markets may not survive, it's not the best career move. And some of them moved on, and in one case to real estate, which probably wasn't the best career choice at the time. So this is one reason, you know, is that
it's a boom-bust industry, basically.
That's right, you know, and the academics need continuity. You know, the second reason is that the attention of quants was diverted from the development of pricing models to the compliance effort, and it's a lot of effort goes into development of the databases, reporting, meeting requirements regarding risk management models advanced by the regulators, and it uses really scarce resources. And another problem is, again, there was the financial crisis, and you know, in the case of a financial crisis, research, you know, is first to be sacrificed.
Vince, thank you very much, and we'll look forward to reading the book.
Yeah, thanks a lot. Thanks a lot, Mark.